Good morning, everyone. Good afternoon, depending on where from you're listening to us. My name is Anna Wcisło. I am a transfer pricing partner with CRIDO, our Polish tax, legal, and business advisory firm. And I am here with Leszek Bogucki, our partner
Hello,
from
good morning.
the
Good
team.
afternoon.
And today we would like to present you a short topic on transfer pricing analysis and its comparison to business valuation analysis. What are the similarities? What are the differences between the two when they cross roads? And how can they contribute to one another? How can they be useful to one another? So let's start with the transfer pricing analysis, a short wrap-up, a short summary, what actually a transfer pricing analysis is. We will, just briefly, I will tell you about what is actually the comparability analysis based on the OECD, and that the OECD introduces such name as comparability analysis, transfer pricing analysis, or a benchmarking study. And from my point of view, from the Polish point of view, but I also believe that from the OECD point of view, there are some slight differences between the three. In Poland, we also have a very specific analysis we call it a compliance analysis, and I will describe it briefly. But our clients also, any types of transfer pricing analysis may call economic analysis or market analysis. So this is the transfer pricing side. On the other side, we have the valuation analysis, which are for asset, intangible, or business valuation purposes. And there are also some similarities and combinations of the two worlds. Okay, so when we are discussing the comparability analysis based on the OECD, of course, this is the analysis to determine the arm's length pricing of an intercompany transaction. Within the OECD guidelines, we see that there are specific steps to be taken when we are preparing a comparability analysis. And the steps I've put here on the slide for you. And within this comparability analysis, we can perform a benchmarking study. So from our perspective, from my perspective as a transfer pricing advisor, a benchmarking study is not the same scope of work as the comparability analysis. A comparability analysis, from my perspective, is a full analysis to determine the arm's length range of a transfer pricing transaction, but it not only is based on verifying, identifying, selecting, and eventually adjusting comparable data from a database or internal comparable data, but the comparability analysis is also determining what is actually the transaction being subject to the analysis, what is the involvement of the parties to the analysis, what are the market conditions, what is the strategy adopted by the parties to the transaction. So it is looking at the transaction from a much wider perspective than looking only at the comparable data from a database. Taking this point into account, we can say that a benchmarking study or a benchmarking analysis is something that we are doing within the transfer pricing comparability analysis. So benchmarking study is an element of a comparability study. Therefore, if, for example, our clients are discussing with us doing the benchmarking studies or the comparability analysis, for us, these are two different elements. So benchmarking study is a much narrower work, which is basically only reviewing the market data, the comparable market data, eventually doing some adjustments, selecting the appropriate comparable data and the sample of final comparables. Whereas, as I said, comparability analysis is something wider. It's also including looking at the particular transaction at hand, at the parties involved in the transaction, the surroundings of the transactions, in order to appropriately estimate and what is the arm's length range. And as I said at the beginning, we also have in Poland analysis called compliance analysis. This was introduced in our transfer pricing regulations a few years back, and it is an analysis that can be performed if we are not able to perform a comparability analysis, a benchmarking study. So if there is no sufficient comparable data on the market, if they are not publicly available, basically doing a benchmarking study is not possible, we can perform a compliance analysis, meaning that we are not referring to any market data, but we are trying to describe the performance of a transaction as much accurate as possible in order to prove that the terms and conditions of the intercompany transactions that we have in place were set at arm's length. So therefore, without going through the full process of benchmarking study, without going through the full process of a comparability analysis, we are trying to do something simpler in order to still being able to prove that the transfer prices are set at arm's length. When we are discussing with our clients, also with the tax authorities in Poland, what is the difference between comparability analysis and the benchmarking study, how to differentiate the two, and also what should be an appropriate, accurate, and correct way of performing comparability analysis, we can ask ourselves the following questions that I've put here on the slide. So firstly, we can ask ourselves if we have actually performed the full comparability analysis for a transaction, or we just, did a simplified benchmarking study. Then, if we are actually doing the benchmarking study, which, as I already said, is the part of comparability analysis, we can ask ourselves if this particular benchmarking study is actually the correct one, the matching one for our particular transaction, which is also which is often the case that it's unfortunately not fully matched. Benchmarking studies to some extent may be quite generic, especially if they are performed on a group level and they are distributed among all the companies, all the subsidiaries within the group. And the transactions of the particular subsidiaries can be different from one another. Therefore, a very generic benchmarking study may not be fully adoptable, fully appropriate to the given transaction. So it is important to discover, to find out, to check if the benchmarking study that we got, for example, from our group entity, is the correct one for our particular intercompany transaction. The same with the market data used in the benchmarking study. So, for example, again, in this very generic benchmarking study, we can have like global data or very regional data, whereas our transaction of our particular subsidiary, for example, seated in Poland, may require locally specific comparable data to determine the correct transfer price. And for example, we can discover that let's say, profitability of Polish comparables can be quite different from profitability of European, Central European, or even global comparables. So this is also an important factor to take into account when preparing a benchmarking study or a comparability analysis. What's more, we need to check if the benchmarking study results, so the range, the arm's length range, is actually correct and suitable for our transaction. So again, if we have a given profitability factor or given pricing of our transaction and it does not suit to the benchmarking study result, we should consider whether the benchmarking study was actually prepared correctly for our given transaction, or maybe some comparability factors should have been taken into account, or maybe some adjustments should have been done to the benchmarking study result in order to better match it to our transaction. So the same happens when, for example, our transfer price from the transaction, from the analyzed transaction, is outside of the benchmarking study range. This is also often an issue we see with our tax authorities, specifically if the tax authorities are doing some adjustments, their own adjustments to the benchmarking study result, which may end up with our transfer price being outside of the range. Then the question might be, what should we do? So firstly, whether the benchmarking study was prepared correctly at the very beginning. Then, if we did all the appropriate adjustments and we use all the appropriate selection criteria for the benchmarking study, and ultimately, if the work done by the tax authorities on this benchmarking study, meaning their adjustments, their selection of different comparables, was in line with our transaction, so basically was arm's length range. So this introduction, this short summary, in this short summary, I would like to again underline that a transfer pricing analysis is not the same as a benchmarking study. A transfer pricing analysis is a much wider is a much wider definition that we should to describe not only the selection of comparable data and the result of the pricing range, the market pricing range, but it should also take into account all the comparability factors from our analysis, from our transaction, and all the specific characteristics of our transaction should be taken into account. Okay, moving forward. So as we described what is the comparability analysis, what is the difference between comparability analysis and the benchmarking study, now let's try to compare the transfer pricing analysis to the valuation, and also where is the actually crossing point or joint point for these two analyses. So from the Polish transfer pricing regulations, if we have a transaction that cannot be benchmarked because there is no sufficient data, or because we have such complex transfer pricing setup that, for example, we need to calculate an exit fee, or maybe we are transferring between related parties something of value which cannot be easily benchmarked by the standard approach, this is the moment when, from transfer pricing perspective, we can use valuation techniques. Therefore, we can perform a valuation analysis in order to appropriately determine the arm's length result of the transaction. And if we do that, from the transfer pricing perspective, we do not call it comparability analysis, because basically there is nothing to compare, there's no external data to compare. We then call it the compliance analysis, but it's all within the transfer pricing provisions within the transfer pricing regulations. And from the Polish transfer pricing perspective, it is called that we are not using one of the 5 standard transfer pricing methods, cost plus, cap method, or TNMM method. It is saying that we are using the 6th method, which is allowed under the Polish transfer pricing regulations. So the other non-standard method, which can be the valuation techniques. Okay, so Leszek, maybe you can tell us when actually is the intersection between the two, the TP analysis and the valuation analysis.
Yeah, so the typical situations when we cross roads and we between our, let's say, departments cooperate are the situation of some intra-group reorganizations considering contributions in kind or transfer of assets or any other sorts of transactions, and intragroup transactions. And in those cases, from a transfer pricing perspective, we would need let's say, typical documentation, some transfer pricing analysis, setups, and so on. But when we go to, let's say, for example, benchmarks, we can end up with a situation that a benchmark, as Anna said, wouldn't be enough for a let's say, non-standard transaction, and a benchmark could then be an input assumption for a valuation made based on typical valuation methodologies, business valuation or asset valuation methodologies, which is called, which we call, let's say, valuation techniques in a transfer pricing world. And then we go to valuations when we do a valuation of an enterprise, organized part of enterprise or asset, or a part of a business operating activity, which can be moved from one place in the group to another place. And we use it. We use the valuation techniques. So it means actually the typical valuation methodologies like DCF or multiples, or we can. Or the other situations when two, let's say, worlds and departments from our business perspective cooperate is a situation when we need to, for example, do a simple or more complicated financial model showing the impact of a TP setup on subsidiaries. When we do significant changes in the setup that could influence cash flows, then it could be beneficial to estimate the impact before we implement those changes into our intragroup transactions. Or the estimation of an exit fee is another example of cooperation in those situations. And here we are showing some differences between the TP comparability analysis and valuation techniques or valuation methodologies. So, for example, from the perspective of a typical TP analysis, we would say that we are focusing on a specific repeatable transaction. And in case of the valuation technique, let's say we are analyzing something that is, let's say, non-standard, hard to assess based on typical benchmarking study, market data. We have to, analyze it from different angles, from use different valuation methodologies. Sometimes two valuation methodologies to estimate the value of, for example, a business or organized part of enterprise. Then we have the difference, which Anna mentioned, that we have in transfer pricing world, we have a typical set of 5 transfer pricing methodologies, and then we have the 6th valuation methodology, which in those situations are the typical business intangible valuation methodologies. So as I said, the DCF, discounted cash flow methodology, the multiples calculation. And in a, let's say, typical transfer pricing benchmarking study, we have mostly we can identify some comparable data based on publicly available databases, while in a situation when we have to move to the valuation world, we often have no comparative data. We can estimate some market multiples for comparable companies, but on many occasions those would not be, let's say, sufficient. We have to also use the discounted cash flow methodology. Sometimes we can also conclude that the multiples, the comparable companies have a completely different level of risk and functions compared to our valuation subject. So we may conclude that the valuation based on multiples is not appropriate. And in case of let's say, transfer pricing analysis, I would say that we have those are based on historical data, which are, let's say, which can vary from time to time, which can be disrupted by historical by situation like COVID, or in our region, war in Ukraine. Then some of the indicators may be, let's say, not comparable to the previous periods and to the let's say current period, but from a perspective of valuation techniques, it's, I would say, even harder, because we have to valuations are mostly based on the future. We have to look at the future forecasted cash flows, or the valuation multiples, which the let's say underlying value behind the valuation multiples. The multiples methodology are also the possibilities to generate cash flows by the subject of valuation. So we have the huge sensitivity of the valuation for changes in assumptions when we estimate the cash flows for many years from now. The sensitivity for changes in assumptions like discount rate, or operating margin, or in case of intangible valuation, for example, the royalty rate, is quite significant. Okay, and those are some typical situations when we, let's say, crossroads, when the transfer pricing perspective influences the directly influences the valuations that we do. For example, maybe the valuation methodology, which is mostly dependent on benchmarking study, actually, which is the relief from royalty methodology typically used to estimate the value of a trademark. And in those situations, we have to, let's say, go back to the transfer pricing world and verify if we considered the appropriate comparability criteria, use the market data for unrelated parties, or if we want to, let's say, use the royalty benchmark from the client. We also would like to, know if the market data used is based on unrelated parties, on market data. Some other considerations might be the difference between the economic and legal owner of the trademark, also to have it in mind when doing evaluation. Other examples are, for example, entities within capital group, which are mostly based on their operating activities are mostly based on providing services to group entities. They are often remunerated based on the markup. For example, some shared service centers within a group. So some significant assumptions based on transfer pricing analysis, which would influence the valuation, would be the markup level, also the cost base on which we calculate the markup to be in line with what the transfer pricing estimated, and also understanding the substance of this entity. So what is the added value to the group? Is it let's say, are those simple services provided, or are those, let's say, crucial services for the whole group? And in general, the nature of activities carried out by the entity. So also considering the independence from related parties, the activities, how much, to what extent the functions and risk of the entity are limited, and to what extent the entity is actually a crucial entity adding value to the group. Other examples are, let's say, financial instruments. So for example, if we consider loans, either as a valuation of loans or a valuation of entity having some loans. Then the interest rate would also be a situation when we might have a benchmarking study, or we might cooperate to estimate an appropriate market level of the interest rate to estimate the value of the loans. Okay, and going further with the valuations from a perspective of, let's say, transfer pricing rules in Poland, in order to have the valuation methodologies in line with transfer pricing rules in Poland, we have to, take some things into consideration. So first of all, we have the valuation techniques have its own place in the valuation in all the transfer pricing methodologies, which is the sixth method. There are also some in Polish tax law. There are also some requirements regarding the valuation reports, which are mostly focused on providing some justification for assumptions, especially the discount rate, which should be based on to what extent it's possible on market data, and to use let's call it average market participant, as we call it in the valuation world, which is equal to arm's length perspective principle in transfer pricing world, which gives us as a result the fair market value of the subject of valuation. And further on, I will focus on some of those aspects and requirements regarding the justification of assumptions from a perspective of four, I would say, let's say, crucial elements of the valuation, of the calculations we do, and the approach we apply. So the valuation methodology and the results which we get, and assessing whether those results make any sense. So starting with the valuation methodology, I would say that we need to let's say have comfort with the valuation methodologies which were applied, and by that I mean that we have to have the justification why we adopted those valuation techniques and rejected the other typical valuation techniques or methodologies. I'm basically referring to the three typical valuation methodologies, meaning the income valuation, market multiples, or basically market valuations, and asset-based valuations. So, for example, net asset value, adjusted net asset value calculations, and replacement cost valuations, and so on. And considering what valuation methodologies should we use, first of all, we have to understand the activity of the subject of valuation, also the functions performed by the subject of valuation, if it's part of a group, if it's not a fully independent entity with all the functions, but it has some, let's say, limited functions. The other companies have some complementary functions. Then we have to, let's say, understand what is the added value to the group where the entity is operating. And the risk of the activities, is it a limited risk, for example, limited risk distributor, or another type of limited risk company entity. It would also be good to have a view on the share of the operating profit generated by the subject of valuation. I mean, especially in case of valuation of assets, for example, intangible assets, we would like to better understand whether this intangible asset is a crucial intangible asset for a given business or entity, or is it just one of many other, let's say, technologies or trademarks used by the entity. And value added to the group, as I've said before, this is something related to the functions, the risks of the subject of valuation. Then we go to the actual calculations. So first of all, we have the cash flow calculation, which mostly refer to the income valuation, the discounted cash flow valuation. So in this case, we need to assess or take into consideration how we approach the key risk regarding the subject of valuation and how it is reflected in the cash flows and both in the discount rate and is it addressed consistently both in cash flows or in the discount rate. And how much, to what extent the cash flows are comparable to market data. So, for example, the operating margin, the growth of the subject of valuation, or the turnover ratios are at market levels. And there are also many other assumptions that we need to have, let's say, comfort with. We need to be able to justify why we've applied such those financial forecasts which we applied, and why we did or did not include any additional risk factors to those financial forecasts. And this is, for example, considering whether the growth is supported by sufficient investments, both in working capital or capital expenditures, and as all the activities have the same level of risk, which is also related to some extent to the transfer pricing quote, when we need to let's say have another look at the functions, the added value of the entity to the group, the group where the entity is operating, because we might have some two different types of activity performed by an entity. In those situations, it might be good to consider whether we have to split the cash flows into two, for example. And also we would need to consider to what extent the entity is dependent on transactions with related parties, because this is also something that, from a perspective of an average market participant, might be a significant factor influencing the value of the entity. Then we have the discount rate. In case of the discount rate, we also need to have comfort with whether the risks are addressed consistently within cash flows and in discount rate assumptions, and what is the risk of we need to focus on the risk of the subject of valuation rather than the capital, the whole capital group, which might be where in some situations we are being, let's say, provided by the calculation of discount rate based on a group level in a different country, on a different size of the company comparing to the subsidiary, for example, in Poland, which is subject to valuation. And what is the market, the currency risk of the subject of valuation, where the company, the entity actually operates. And at the end of the day, to be able to justify the assumptions behind the discount rate, we need to base them on market data to the extent where it's possible. And then we go to the valuation result. We at the end of the day, I would say in a valuation process, we need to ask ourselves whether the valuation makes sense and compare it to the benchmarks which are available. For example, the market capitalization, if the company is publicly listed or is a part, or even is a part of a listed company or group. How does the valuation, for example, income valuation, compare to multiples of comparable companies? How it's compared to alternative valuation methods? I'm not saying we have to, on every occasion, do all the valuation methods, but to have a high-level perspective of what could be the value using other valuation methodologies. and whether we have some historical transactions relating the subject of valuation, the given, let's say, subsidiary, whether any historical transactions that we can refer to, and ask ourselves whether our current valuation makes sense, taking into account what happened between those historical transactions and the current situation. And just, at the end of the day, it's good to ask ourselves whether the value makes sense, how much it is actually worth. I mean, the subject of valuation, the entity, the subsidiary, the whatever we are analyzing. And now we will go through a simple case study where we will show you how, let's say, we approach those situations when we have especially some intra-group situations when we have to value an entity which is, let's say, highly dependent on group transactions. So we have a situation when we analyze an intra-group shared service center, and how we ask ourselves how we should do evaluation of such a company, what should be considered. So first of all, I would say that we need to look at how to what extent the company is dependent on the group, and does it have any other activities, and are those activities significant? What is the margin markup in case a company is remunerated based on the markup? Is it at market levels? Does it make sense? And what are the functions of the company, the value added to the group, as I've also mentioned before, and to assess what the company actually owns. So I would say that a typical situation might be that the company, as such an entity, controls the contracts with related parties, which might have a expiry period, of course, some limited or even no customer base, or a limited customer base of unrelated parties. The company might have, in some cases, some significant net assets, which could possibly also be adjusted, and the company might have also a workforce of some value. So those are, the factors to be considered in such a situation, and to be applied appropriately in evaluation technique to be, let's say, consistent, especially if we do also a transfer pricing analysis of this entity, of this group, then we would like to have the evaluation technique consistent with those analyses. Other situation is a distribution activity related to, for example, Polish market, which is planned to be separated from the company, and also what should be considered. As mentioned before, is the company dependent on the group? What are the, let's say, alternative scenarios for such a distribution activity? Does it have any other unrelated customers? Is the margin at market levels appropriate to let's say, limited risk distributor? Does the company own the customer base, or have a specific access to the Polish market, which has some value? Or maybe does it have the trademarks required to operate on Polish market, which might have also some significant value? Okay, now we will move to the another part of the presentation, which is tax audit of transfer pricing and also valuation.
So basically, yeah, I will take on from now, Leszek. So basically, to sum up what just Leszek said, is that as you may see, the valuation of businesses is crucial for specific transfer price valuation. Using valuation technique and valuation analysis is crucial for specific types of transfer pricing transactions that cannot be approached by the standard methods. But on the other hand, if we are doing the valuation analysis, we also use some benchmarking data for this analysis as well. So both the transfer pricing world is crucial for the purpose of valuation analysis. And also valuation analysis are used for transfer pricing purposes for non-standard transactions. Now, to summarize shortly, we would like to present you a few points of our Polish transfer price tax authorities and their approach to transfer pricing analysis, and also their approach to valuation analysis when they are auditing our clients. So firstly, what the tax authorities with respect to transfer pricing are looking at most often is the similarities and unified approach that is presented as a factual background of the transaction, what is presented in the transfer pricing documentation, and what is presented in the transfer pricing analysis or benchmarking analysis. If these show a common approach to the transaction, if these show the same risks, the same assets involved, the same processes of the transaction, so that there are no material differences, and so that the tax authorities may not say that benchmarking study is, for example, inappropriate for the given transaction. Next, of course, our tax authorities will be verifying the choice of appropriate transfer pricing method for the analysis, which period of data is chosen for the analysis. So multiple year data, or the last year data, or current data maybe. They will also look at the selection of comparative data, and finally, if we did any adjustments, and if yes, whether these adjustments were actually needed. Maybe there were too few or maybe too many. Next one, if the comparability criteria have been actually included in the analysis. So this refers to what I said before, meaning that we cannot use a very generic benchmarking study for a particular transaction, or not always can we use that, because sometimes not all the comparability criteria have been met. Next thing is that our tax authorities can often take the transfer pricing analysis prepared by the taxpayer, and they can try to modify it to better suit the transaction. So either they will carrying out their own analysis and comparing these two and the results of these two, or they will do some, for example, cherry picking of the comparables, of the comparable data. They may verify if all the adjustments were made appropriately, or if the range was determined correctly. There might be also some level of negotiation between the tax authorities and us as representatives of the clients, or between the tax authorities and taxpayers themselves. So no benchmarking study, no comparability analysis is fully safe from the tax audit and fully resistant to the tax authorities review. But the more compliant, the more accurate it is to the actual transaction, the less we have to worry about any changes that the tax authorities might potentially make to the result of the analysis. And when it comes to valuations and the verification of the valuations from the tax authorities' point of view, firstly, Leszek, maybe I will start with the first one. You will finish with the others. So, firstly, from the Polish transfer pricing regulations, thanks to the Polish transfer pricing regulations, the tax authorities have access to multiple information about the taxpayers and about these transactions. They have the so-called TPR, so transfer pricing reporting forms, meaning that they have direct access to the information about the transactions, about the pricing, so they can easily compare our transactions with the transactions of our, for example, competitors from the same sector. They have their own access to benchmarking databases, and also the reporting of DAX6 reporting of tax schemes. They also have access to those, and from that they can see information about transactions, specifically non-standard transactions dealt by the taxpayers. Okay, Leszek?
Okay, and as I've said, that also the valuations are now, let's say, more settled on the legal perspective, on the tax law. The other transfer pricing method, the sixth method, the valuation techniques, were introduced to the tax law in Poland. And also we have the restructurizations, which result in a calculation of exit fee, settled on the legal perspective, and also reference to the hard to value intangibles. And the other things that makes the valuations at risk of let's say tax audit, tax controlling the valuations by tax authorities are the macroeconomics, the increased volatility in recent times. Some extraordinary events, especially in our region, which is, for example, the war in Ukraine. And as something that I also mentioned, that this is the sensitivity of valuation to changes in assumptions. The tax authorities are or might be in a future might be more aware in the future that the valuation is quite sensitive to changes in assumptions, like the discount rate or the royalty rate in a trademark valuation, for example. And also in general, the knowledge, the awareness of, for example, the fact that usually the net asset value of the company, so the book value of the company, is something different than the market value of especially an operating company with operating activities and growing market and so on. Then the market value is typically completely different than the net asset value. And there's also awareness of this fact, because to some extent, on many occasions, the net asset value was let's say set in the intragroup transactions as a market value, and those situations were accepted by tax authorities. The situation now changes, and there was also some more awareness of transaction requiring valuations of those transactions, which were also mentioned before. So, for example, contributions or transfer of assets. And there are also trainings undertaken by the tax authorities to more understand the valuation techniques, valuation methodologies.
Okay. So, ladies and gentlemen, that is all from our side. I hope that you found our webinar informative. If you have any questions, additional questions to ask, please do not hesitate to contact us. Here are our contact details. And thank you for listening today.
Thank you. Goodbye.
Goodbye.